Welcome to my channel. My name is Carol, coming to you all the way from Johannesburg, South Africa. I often get asked the question, what is the difference between a set of financial statements, an independent review, an audited set of financials, and management accounts? Well, they're not the same. Similar, but not quite the same. I'll start with management accounts. Management accounts can often be prepared internally, sometimes by an external accountant, but often internally, just for the business to be able to assess its performance either monthly or over any other period. So it can be over a 2-month, a 3-month, a 5-month period. You can even have management accounts going into 12 or 18 months. It's simply a set period that you're looking at the performance of the company. It will still contain the same income and expenditure, statement of comprehensive income, as we call it now. It should also contain the statement of equity, which is linked to your statement of, your balance sheet. Let's call it that. Most people remember that term. So it will still have the usual reports, and it will have perhaps your cash flow and just a little bit of notes, but it's normally not a set of financials that need to be signed off necessarily by a registered accountant with a practice number, except if you are submitting those management accounts to a bank or financial institution for a loan, then yes, by all means, they've got to be prepared externally and signed by someone with a practice number. Now, these will usually give specific details up to current, to be able to tell whoever you're submitting how well the company has been performing to date or to the last month end. The other set of financials, we call it a compilation. You're simply compiling financials and you're not auditing, you're not independently reviewing them. It's the same set, but usually it will be during your year-end period. So for instance, if you have a February year end, we would expect your financials to run from March of the previous year to Feb of the current year. And that would form your 12 months financial period covered in your compiled financial statements. Again, these have got to be prepared and signed by an accountant with a practice number registered with an accounting body. Now, these financial statements then can be independently reviewed. This then means that in addition to just being compiled, they have been reviewed by someone who has the know-how, someone who is licensed and practiced with a practice number, has not only had their accounts prepared, but they've actually reviewed. So they've looked at, for instance, the cash balance on the balance sheet, and they've compared it, your bank balance, they've compared it to your bank statement, your loans. They've made sure that the balances reflected are correct. So it's all about not misleading the reader of the financials and making sure that these financials are actually accurately representing the performance of the company. So if the financials are independently reviewed, it'll cost you a little bit more than a compiled set of financials. And as I say, they are signed with the report that states that these financials have been reviewed independently by a different accountant from the accountant that has prepared the financials. Now, someone with a CIPA number, professional accountant, I think cyber as well, some of these accounting bodies do have the permission to review independently financial. Of course, chartered accountants can also review your financials. So an independent review is a step up from just the normal compiled financials, and it's reflective of the fact that someone has reviewed those financials and is happy with the final results. The last set that I'm going to talk about is an audited set of financials. Now, the only person that is allowed to sign off on an audit, as we call it, is someone who is a chartered accountant, registered with SAICA with a practice number. And they can then audit the financials. Now, an audit, as some of you may know, is intense. It's an extensive process where different checks will be performed on the sales, on the cost of sales, on the expenses, as well as the balance sheet items. Now, the auditor will then be signing off to saying that according to the checks that he has done, the accounts have been prepared correctly, they have been audited, which just gives the total assurance that their financials are actually accurate and that there's no errors, there's no misrepresentation, and therefore they can be relied upon. Now, in the old days, all PTYs had to be audited. In other words, the financials had to be signed off by a chartered accountant. They had to be checked by the auditor, not just prepared by the accountant or bookkeeper. With the Companies Act that came into play, we now no longer need to audit all PTYs except in instances where they have what we call a PI score, public interest score, of above 100. So if you're just a small company trading, your turnover is probably about 2 million or even less, you no longer need to have your financials audited. They can just be compiled, or if you want, independently reviewed, and it'll cost you a whole lot less. In essence, those are the differences between the types of preparations of financials. I hope this helped. Please like our channel, hit the subscribe button, and be a part of our community.